2, 1.
Boom.
Yo, 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 what's up? Judah
I,
Hoover, good to see you. It must be Thursday.
it must be Thursday because we are coming to everybody here live with the latest real estate news, our take on what's going on. My name is Judah Hoover, and that guy right over there is Josh Weidman. I am a realtor and a real estate investor. I want to list your central Pennsylvania house and help you get top dollar for it. My buddy Josh is a real estate investor as well, and he is a hard money lender, and he wants to lend you money for any and all of your real estate flips.
Well, Judah, I think you underbid yourself here in the intro. I mean, little do our viewers know that you run the landlord and
Investor Mastermind Group.
the
Investor Mastermind Group.
LAMG Harrisburg. I always screw up what the LAMG stands for.
Right.
But and tonight at what time? 6:30?
No. Next week.
Oh my goodness!
We are
I'm
a week
so
early.
glad I didn't
It's fine.
screw that up.
Because they can RSVP. They can go to Meetup and they can RSVP. We have interesting speakers every week, every month. We meet the fourth Thursday of every month at the Red Lion Inn, the Red Lion Hotel in Harrisburg.
Yeah.
And here's the deal. We don't pitch stuff and sell stuff. Like the guy who's there, he might tell you about, the guy who's coming today or next week is he does short-term rentals.
Mm-hmm.
And so he'll tell you about how he can manage your short-term rentals, but really he's going to be there to teach us about short-term rentals. What's good about short-term rentals? He manages a bunch of short-term rentals in central Pennsylvania and in Florida. And so we're going to have just a good conversation about short-term rentals. There's a lot of people who have been in the real estate game for a while, and they're like, I should kind of know something more about that. It's kind of like crypto,
Yes.
It's like, ooh, I kind of want to invest some money there, but I don't know how to start. I just need somebody who I can ask some questions of, and I just kind of need a good overview.
Sure.
And so that's one of the things that we're going to be doing is talking about the latest and greatest information, but also some of the basics. So if you know nothing about short-term rentals, or you think you know everything about short-term rentals and you're want to know what the coming trends are and what latest developments there's going to be in the short-term rental business, check out the Landlords and Investors Mastermind Group. Doors open at 6:30. Presentation goes from about 7 till about 9. And there's just phenomenal networking opportunities before and afterhand. And Josh,
that's right.
You wonder why is Josh telling me? Why is Josh telling our audience about that?
Because I'm going to make you take a T-shirt. And one thing I want to ask your guest about these short-term rentals. This has been bugging me, Jude. I'm sorry to talk over you. I've been trying to hold it in. You did such a great job delivering about the meeting. But one thing I want to ask him is, where's the saturation point? Because at some point you can't have a whole town of vacation rentals. There's nothing to come and see, and I wonder what that is. I think in the years to come we'll see that. I don't think we're close to it now, but it's pretty interesting, right?
Well, especially what's also crazy, Josh, is like you and I know people who like flipped a house and they broke even or lost money, right? Yep. You and I know some people who, they got a rental that, it's breaking even or losing money or, they got to get out of a bad deal. I don't know of many people. You and I touch a lot of people in the real estate space. I don't know many people who have done short-term rentals and they're losing money on them. We are kind of far away from that saturation point. The market seems to be able to listen. If you try and do a short-term rental on Green Street in Lancaster, yes, that's not going to be successful. But by and large, it seems to be a pretty successful growth area in the marketplace.
I have a real estate friend who owns a Airbnb rental in one of the worst blocks. And I'm strike that. Used to be one of the worst blocks in Philadelphia, and he started renting it short-term rental when it was like that, and it was really, really nice. But he used that as kind of like a bridge to the point where today now the neighborhood's kind of transitioned, and now there's an extra zero behind what he paid for it, and like really significant returns. But he did great in a bad neighborhood because the cost basis was so low. You're able to come into Philly, stay the night, and it's not like, drive by, get shot type thing, but also maybe not the kind of place you want to live. But anyway, doesn't matter.
Right.
Man, one rabbit hole
But
and we're 5 minutes in.
The point that I was going to make is the reason Josh is even mentioning my club that I run is because Josh has found clients for his business at my club. Josh has found people to do not just on his hard money business, but also as a real estate investor, people to collaborate with and do business with. Josh has found service providers at my investment club. And that's really what we do is we lead with value, and we just try to enrich and make people better real estate investors. So check us out, the Landlords and Investors Mastermind Group, the 27th at 7:00, the Red Lion Hotel. It's the Red Lion Hotel, Harrisburg/Hershey, because it's like kind of in between Harrisburg and Hershey.
Yeah. Yep. All right. Moving on to our subject for the day: fear and loathing in the U.S. housing market. Oh my gracious! So I'll tell you what. This weekend, I try to start prep for the show around Sunday. And I start kind of looking at news articles and kind of get a feel and a trend in where these articles are being written. And then this morning I jumped in and was looking at some updated news articles and just put in real estate news 2020, right? There's about 17 articles with this title. Will the real estate exact same title. Will the real estate market crash in 2020? I mean, totally different sources, different authors, but all of them had to come back to this idea that we're crashing, right? And, man, we talked about this last week, how, everything popular is wrong, and that idea of like where the populace goes to, it's probably not the place you want to invest. And, I think there's a lot to this, the fear that's going on in the housing market right now. There's a lot going on with that is based in fear and not in knowledge and really thinking through the pieces of the puzzle. And so I wanted today to really dig in and say, hey, look, what are we looking at? What are we looking at here moving forward? What are the pieces that go into the housing market that either make it stable or flimsy or problematic? And where do we stand? And so, I think it's really important to be able to make an educated decision when you're moving forward with a purchase like an investment property or your own home, and knowing where things are going to be. So let's jump into it. First and foremost, I think this is what's on the tip of everybody's tongue, right? The interest rates are going up, and we saw a jump of 80 basis points over the last year in the 30-year fixed conforming 30-year fixed mortgage rate. That's a pretty big jump.
Now 80 basis points, for those of you that don't know, that's 0.8%.
That's right.
So if interest rates were 3% a year ago, saying they went up by 80 basis points means they're 3.8% today. They're 3.80% today. Think of it that way. So 80 basis points, 100 basis points is 1%.
Yeah, and I think that in last January we saw a dip in the interest rates down to like 2.64%. Not to about, that's what it was, And then all of a sudden things jumped in the spring, and people looked around and said, "Oh man, are we going to have 4% interest rates? Are we going to have 5% interest rates?" And then they dove back down in June to 2.65%, just like that again. I don't think that's what we're going to see here, right? I think that inflation, we're going to talk about this in more depth later on in the show, but inflation has caused the Fed to look at all of the capital that they've injected into the market and the really cheap money that people are borrowing and refinancing with, and said, you know what, we've gotten things a little bit out of control. And they've said that they're going to raise interest rates up to 4 times this year. Now that doesn't mean a quarter of a point every time or a point every time. But there's a lot right now that is gonna depend on where those interest rates are going to go. And in the long term, if we go from a 3.45% to a 7% interest rate, it's going to impact the value of housing. But in the short term, if you have a house that's about to hit the market, you might be in the best case scenario right now, because shoppers, home buyers, are out looking at houses and saying, "Oh man, I could have a 4.5 or 5% interest rate if I don't lock this in right now. Let's buy this house. Let's
Right.
buy now before rates go up. So I think interest rates are something that definitely needs to be watched. I think that it's going to have a cooling effect on the housing market, but I don't think it's going to be crazy, and certainly not in the short term.
Yeah, I completely agree. I think that the Fed is going to try and pull some of the money out through interest rates, but it's going to take an awful lot to pull out as much as there needs to be. But there's not going to be as much pressure. I think that it's going to affect other things and other areas of the markets much more than it's going to affect housing prices.
Yeah, agreed.
Because here's the thing we're seeing people making offers without appraisal contingencies willing to pay for the difference in cash. We're seeing people pay $30,000 over asking and putting 30 or 40 or 50% down. People have the surplus cash to pay for the difference in monthly payment. And there's a lot of people with a lot of cash that's been generated over the past 5 to 7 years that they can float a slightly higher payment. I don't see interest rates affecting payment, therefore affecting purchase price is not something that I see is going to happen this time around.
So I've got one alternative view on that, and I think it's kind of interesting. We saw this in 2008 for sure, where you had people that were in the real estate service industries, like agents and brokers and things like that, that they went through a 2 or 3 year period where their income went from, $50,000 a year to $400,000 a year. And instead of socking away a lot of that cash, they built a lifestyle around a $450,000 a year income. And, there was a lot of irresponsible spending at that time and lifestyle at that time that it's not sustainable. We're not going to have competing offers on every house for infinitum. It can't happen. But all right, let's go back off of interest rates. Inventory, this is a big one, and you brought this up last week. Inventory, it's at such a ridiculously low level. I mean, it's like trying to find a pack of toilet paper during the lockdowns, right? Like, we're talking about 1 million homes on the market in December of 2021. So last month on Zillow, 1 million homes across 52 states. That's 20,000 roughly. What did I say? 52 states? My goodness. 50 states, excuse me. That's roughly 20,000 houses on the market for every state. I mean,
right.
That's not many houses at all, right? That's down from 1.7 million in December of 2020, when everybody would agree it was insane. It was insane how low the inventory was. It was insane how much competition there were for the few houses that hit the market. And now we have almost half of what we had a year ago.
Yeah, and if you go back 2 or 3 or 4 years before that, this trend has just continued. And if you go back 2 or 3 or 4 years and look at what the population was, obviously we have less housing for more people. And it's not just that, Josh. Like, we also have a whole lot of houses that have come offline. In a lot of every year in our major cities, Detroit and other places like this. We're looking at opening an office in Detroit. It's how I know this. If you look at satellite images of Detroit or just like airplane images of Detroit, like there's whole blocks that are just like green. You know what I mean? Or there's like 2 or 3 houses where there used to be 10 or 15. We just don't have as much of that old housing stock as we used to. And we're also not building new houses at the rate that we need to. And there is a major housing shortage in America that this inventory problem is not going away anytime soon. And the drip in the bucket of inflation is just doing nothing compared to the hole in the bottom of the bucket for our inventory. We've got more water running out of the bucket than we have coming in.
Well, and what I thought was so interesting about this study was that out of 327 U.S. housing markets, 254 of them, they had inventory levels more than 30% below, like 30% drop below December 2019. And I mean, I remember that time because I was watching the market closely. I thought we were going to have a dip in housing in the spring. I thought we'd have a correction, but the inventory just kept things rolling on until March when we had all the shutdowns. So, I mean, we've had low inventory here for at least 3, 4, 5 years that just continues, and we don't seem to be able to produce enough housing. And I think part of that is the inflation that goes on, the added building costs and all the other things that go along with it. But it's not a problem that has an easy, push button solution to it.
Well, I also think that as we see interest rates go up,
yeah,
I think that it actually could hurt our inventory problem, because what we're going to have is we're going to have somebody say, geez, I don't want to move.
Yeah.
I don't want to. I might be able to move into a little bit better school district, or I might move into a house with one extra bedroom. But you know what? I'm not interested in moving because I don't want to go from my 2.5% interest rate to my 3.5 or 4% interest rate. Whenever they go up, people are proud of that low rate, and it means that they hold on to the house that they're in, which means that house doesn't cycle through the inventory on the market.
That's right. Remind me to talk about BlackRock. This might be our topic for next week, but I want to bring it up on this show because I think it is a good tell on where housing markets are going. So, all right, inventory, mortgage delinquency rates. We talked a ton about this in August of 2019 or 2020. You and I talked about this like in depth because there was 12, 16 million people that stopped paying their mortgage or more than forbearance.
Yeah, we thought that it was a leading indicator potentially for all kinds of problems. We thought that there was potential for a whole lot of inventory to be dumped on the market. It never showed up. And today, delinquency rates are right back to where they were pre-pandemic, which means we have a healthy paying history. I was really worried when the brakes came off moratoriums. Would there be a flood of people filing for evictions? Would the eviction courts be clogged up? Would and would there be a whole bunch of people now with evictions on their records that then I couldn't, get them housing?
Yeah.
I couldn't fill my units. Like there was a whole bunch of stuff that once we came out of the pandemic, it was going to be interesting to see how it played out. And by and large, this is one of those things that's kind of played out okay.
I'll tell you what, I was so against the the mortgage abatements and stuff like that, but the truth is it really gave people the chance to figure it out. And with the increases in hourly rates for employees, with some of the increases in pay and things like that, I think people that they worked through it, they figured it out. And the nice thing is that it was something like 82%. Oh, I did put it on there. 82% of lost jobs from March and April of 2020 were recovered by October. That's phenomenal. I mean, it's amazing. It's amazing. So for a long time, there were a lot of people saying, well, hey, next spring, we're going to have a lot of foreclosures. We're going to have a lot of these REO properties hitting the market. But the reality is they're not there. They're not there. People have recovered. And what we see here is a low likelihood of a ton of defaults and a really strong banking system that's made good loans to qualified borrowers. And that's exactly what we want to see on the basis of a strong economy. So that's good stuff.
Yeah, I was in the mortgage industry the last time around, and everybody has been saying to me, oh, well, that's what we thought last time. No, pretty much everybody knew that was in the banking industry that we were writing a bunch of, funny loans. And I mean, I'm not just saying this, like, I feel like I was writing good loans, but I knew there was a lot of people who were writing funny loans.
Yeah.
And even the banks knew that, and everybody who came up with those programs, there's not, unless it's like for some certain self-employed people and for some certain, the closest it comes to a stated income program or no income verification is they want to see your income coming through your bank statements. They're still verifying the income. It's just instead of seeing it on pay stubs and things like that, as a recognition that there's a lot of people out there who, and it's a program that I wish there would have been before, for people who are making cash, you know, deposits and things like that's kind of off book and things, and people who are making Uber and in the gig economy. So, but
There's
that's the
also,
closest it comes to funny loans. Everything is
yeah.
underwritten and said this person I verified actually can afford this.
Well, and there are ninja loans out there. I mean, you can get a no doc, no income verification, no credit score, but it's going to be at like 45% loan to
Right.
cost. And
Right.
and
The
that's
loan to
that's the
value
thing.
is going to be super low.
That's right.
Yeah, exactly.
Yeah.
Which means the bank is protected and they can take it back at any time.
Exactly. They take it back, they make more money, right? So the big thing here that is causing this whole conversation is inflation. And this is a whole rabbit hole that we could go down for years and years and still not really understand it. But the idea here is that there's a lot of money, that money's really cheap, debt's really cheap, and as a result, more people have more money to go out and spend. And when you have a shortage of supplies and a glut of demand, prices go up. And we've seen it in the housing market with an increase of 25% across the board in the last year. I mean, that's wild. That in and of itself just blows me away. But you know what? That's a heck of a lot more ahead of the pace than the annual inflation rate right now, which is at 7%, which is still super high. We haven't seen this since the 80s. But I mean, I think that, yeah, go ahead. Sorry.
I was just gonna say, yeah, it's crazy high. And I was just talking to a guy who owns several well-known local hardware stores,
Yeah.
and he just looked at what he spent on inventory, month over month, this year versus last year, and his costs are up to move the same amount of product, 12%.
There you go.
So
Yeah.
now everyone talks about consumer pricing index, the wholesale, the producer pricer index, and that's one person. But like a hardware store is kind of a good, it's a retail store. There's a lot of things get baked into that. His taxes are also higher. The price of his electricity is also higher. His wages are also higher. We're gonna continue to see inflationary pressure. I was talking to a guy who owns a chain of car dealerships, and he says, he has apprentices coming in, on his mechanic, where he's got to pay them anywhere between $18 and $23 an hour, and that just pushes the rest of his wage scale up.
Yeah.
And he firmly believes that even though it's not officially the minimum wage, like how we all kind of know that $15 an hour is like minimum wage right now.
Right.
He says 2 years from now, the way he's seeing this trend go, he thinks minimum wage is going to be $25 an hour. I keep on.
Well, so you look at that. You look at that. Okay, just as the. I mean, that's certainly inflation, right? But it's not asset inflation. That's the kind of inflation that never goes away. Once you make $20 an hour, if somebody offers you 10, you're like, well, why the heck would I leave this $20 an hour job? And that's going to be compounded, I think, with the loss of a lot of the skilled trades and development of skilled trades. You go out onto a job site where they're building $1 million property, or they're doing some high-end remodeling, and what you see is 55 and 65-year-olds putting in the plumbing, running the electrical lines, putting in the HVAC system. And it's not going to be long before those guys retire, and there's nobody to come in and fill the gap. That's not true. There's not nobody, but there's few, and so it's
not as many as we need.
That's right. That's right. All right. So this is kind of on the same, I don't know, with the same backdrop here. I wanted to talk about Blackstone. Blackstone announced that their next real estate play is going to be rent to own properties. Now, these guys are pretty darn smart, and they have a crap ton of money, right? And typically smart people with a crap ton of money, they don't make stupid investment decisions. The way they have this structured and set up is that they're going to allow people with credit problems, right, to go and select a house that they want to buy. Blackstone will buy the house, and then lease it back to them with an option to buy over a 5-year period. It's a pretty standard lease option situation. Well, why the heck would a company like Blackstone put themselves in a situation where they're going to be obligated to sell a property, later on, or they're going to put their capital out to grab this asset, and then later down the line they're going to sell it. If the value goes down 50% or 30% or 20% or 10% in the next year, that's going to be a heck of a problem for them. So I think that really is a good argument that all of the naysayers, everybody talking about, 2-point rate hikes or, throughout the course of the year and the crash of the real estate market, I just don't see it happening. I don't think the indicators are there.
You think that Blackstone doing what they're doing is an indicator of long-term strength in the real estate market?
Yeah.
You don't think Blackstone would be doing that if there was not substantial evidence that real estate values are only going up, not down?
At least stability, right? Maybe not strength, but certainly stability. And I think that that's really what everybody's been looking for. We live in a world right now that every other Tuesday, all the rules change. You know what I mean? And that is very confusing and frustrating for investors and normal humans to get their head around. We want consistency. We want, we want to know what to expect in the future, and I think that by looking at some of these big players, it's a pretty good indicator of where things are going.
That's interesting. That I wonder how that's going to work, is whether they're going to offer commitment letters and pre-approval letters the same way that the bank would, so
right.
Me as a buyer's, because Josh, if I'm a buyer's agent and you're a lister's agent and I bring you Bob and Sally Smith and I say, hey, accept our offer, take your property off the market, you're going to say, how do I know they're going to be able to buy in 30 days? I say, well, here's a pre-approval letter from well-known local bank or acceptable local mortgage broker. And you say, oh, okay, I've worked with that mortgage broker in the past, or I can call them or look them up and make sure that they're a reputable mortgage broker. So yeah, I mean, it's one of those things where if Blackstone is going to allow people to buy a house, they're going to buy the house for them.
They're buying it, so they're going to take title and then rent it back.
So they're going to have to, you're going to have to identify that property, and it'll be. I'm wondering what the mechanics of that will look like. But I can tell you this: Josh and I are going to research the mechanics of what that's going to look like, right. and we will bring it to you here in a future episode of the Build and Grow with Real Estate Show, because that's what we do.
That's exactly right. One thing that I forget it. We'll cover that later. Lots of great things coming to the end of January. We got one more week in January. Next week, I'm going to be coming to you with an interview. Judah has a prior obligation, but we have a commitment that every Thursday at noon, we're going to have Build and Grow with Real Estate Show. So I'll be back here with you next week with a special guest, and Judah will be joining me the week after in February, and we will be rocking it out right here live on Facebook. See YouTube,
everybody. Have a great day.
All right. Awesome. All right, guys, have till we see you next week, have a great week and go make some money. Take care.